Hi, hi everyone. Welcome. Hello, evening. Hope you guys are doing well. Welcome. Uh, there are like 4 minutes, so let's wait a bit. Already have 10 people. It's great to see. Okay. See more people coming in. Hi, welcome. Hey, looks like we have quite a few people here already. 23. Um, Suppose we can wait for maybe 1 minute, just in case other people are joining in. Whoa. Hi everyone. Hi. All right. This we already have a quite sizable amount of participants, I suppose maybe it's time to start it. So I've already said hi to some of you guys, but officially, welcome to the AFR free training. And yeah, I really appreciate all of you guys for being here. I hope you guys are doing well, and I hope the course is going all right so far. And if you want to share anything, please let me know. So also please turn on the cameras if possible. But I completely understand if you don't want to. It's quite late now, and yeah, I also sometimes don't want to turn on my camera. But it would be great if you can do that. Just a little bit of introduction about myself, I suppose. My name is Dean, but you can also call me Chen. I don't really mind. I prefer both of them equally. So the picture on the left is me when I was in China 2 months ago. I looked a little bit chubby there because, well, I had a lot of nice Chinese dishes there. It's really hard to resist. Yeah, I'm an ABE student, currently doing second year, and I'm specializing in emerging markets. So, well, it is quite a niche specialization. And for those who are doing EBE, as I assume a lot of you are, if you have any questions or you're interested in knowing what you can expect from different types of specializations, feel free to let me know. Here is my phone number. You can ask me on WhatsApp. Uh, you know, but although I don't think you need to be too worried about it now because it's still your first semester. So, but just in case you're interested, yeah. So I received an AFR 9 from AFR last year. So I'm quite proud of my grades, and that's why I will be a tutor for this free training. As well as I have a free full course towards the end of this period, but I will get into it towards the end of this training session a little bit. Uh, so yeah, I'm from China originally, but I've lived in Poland for quite some time. Then here I moved here to Maastricht. Uh, I'm actually kind of curious, just a curious question, because I'm seeing a lot of names that suggest different, very diverse nationalities. So I'd like to ask if you guys would like to share a little bit about where you're from in the chat. Belgium? Okay, interesting. Germany? Spain? Okay, it's really cool. Czech. Okay. Also, that's the Eastern Europe. Nice. Italy, Netherlands. Great. It's great. Yeah, I think that's pretty cool to see such a diverse community, right? And I think that's also one thing about Maastricht University that's so unique. We kind of have people from various different nations, and it's really cool to see that. Uh, yeah, I guess one last thing I'd like to share about myself is my interest. Mainly it's movies and TV shows. I also like the arts and history in general. Uh, so a TV show that I've seen recently that I really like to recommend to you guys is The Penguin. I'm sure a lot of you have already heard of it. It really surprised me. I think considering it's basically based off a superhero universe, but well, I find it's really really nice. And if you guys have any other shows or movies that you like to recommend, you can also leave it in the chat to share. I'm always open to new media. Yeah. Anyways, that's enough about me, I suppose. Uh, just a little bit info about the how the Athena courses are conducted. So I'm not sure how many of you guys have already heard of Athena or have attended our QM1 trainings even. For those of you who did, I'm sure you already have a good idea as to how this procedure goes. But for those who are new here, I'd like to just walk you guys through it real quick. So, of course, in Athena, our main goal is to make sure that you guys are very well prepared for the exam. So everything from theories to example to practice questions are going to be exam relevant. And first, I will be defining the definitions, the concepts, and theories that are important to the exams. Then I will be using these theories in numerical examples to better clarify them. And lastly, we'll be doing some practice questions that are very similar to what you can expect from the real exams. So this way you guys can better consolidate the knowledge that you've learned. Okay, but if you guys have read this last part of the slide, actually, I would like to maybe go compare a little bit of the difference between the free course and the full course, just real quick. So there's this 24/7 WhatsApp aid. Unfortunately, since this is a free course, we don't really have it for that. This is only exclusive to the full course, which you can find on the Athena website. So of course, for full course, you can expect all the content that's irrelevant to this period of exam to be covered there. It's going to be 12 to 15 hours long, and you will have a WhatsApp aid that is dedicated to answering your questions, and I will be there to actively help you solve questions that you don't know. Of course, for the free course, if you have any questions about accounting, I'm also in your EBE chat, so you can ask there. Sometimes, obviously, I won't be able to answer all of your questions, but I'm sure a lot of peers are doing the same courses you could help you out. So yeah, that's, I suppose, what you can expect from this course from Athena. And I'd like to also set up a little bit of expectation about this from you guys, actually. So of course, this is not a lecture. We really try to make this as interactive as possible. So I would highly encourage you guys to participate actively in this course. By that, I mean, if you have any questions, feel free to ask me in the chat or unmute yourself. You can also privately chat me if you don't feel like talking in the public. Also, I would like to, again, encourage you guys to turn on the cameras if possible, since that really helps you with engagement and active learning. And yeah, also most importantly, when we're doing exercises towards the end of this session, I would really hope that you guys are doing them together instead of waiting for someone to send the answer in, since this is practicing is always the best way of learning, right? Okay. Again, you can send the answers privately to me if you don't feel like sharing them in the public chat. All right, I think I've said everything so far about the introduction. So let's get into quickly about the agenda for the day. So this free course, mainly we will be talking about chapter 6, which is the inventories. I believe it's what you guys learned from the last week, right? And I feel like it's it's a topic that really frequently appears in exams. And there are some concepts that are, let's say, tricky to understand. So I feel like this could serve as a pretty good refresher for you guys. Also, if we have some time left, we could also touch on chapter 8, accounting for receivables, which are, I believe, the content that you're learning this week. Okay. Is there any questions? No. There's one. Okay, great. Great to know that. Perfect. Okay, then I suppose let's start. Okay. Before we officially start, just one quick question. How confident are you guys on the week 3's content, specifically chapter 6 out of 10? Okay. Okay, I'm seeing 7, 5, 4, 4, 5. Very diverse range of answers. Okay. Yeah, I've seen some people with 4 and 5, some people with 7 and 8, 6 to 7 to 8. So for those who are already pretty confident, I hope that at the end of this course, this session, that your confidence level will go even higher. And for those who receive a little bit lower, 4 to 5 or 6, I'm sure after this, you will be a lot more confident. Besides, there's really no need to worry. You still have a lot of time and till the exam, so there's sufficient amount of time to master this content. So yeah, but hopefully you guys will be a lot more confident overall after this class. Okay. Yeah, let's get into the meat of the class, right? Which is the chapter 6 inventories. So I figure it's good to let's first classify and determine the inventory, which is the first topic, right? In chapter 5, we talked a little bit about merchandising company, right? So merchandise inventory, they consist of an array of things, but they mainly have two characteristics in common. Just to jog your guys' memory a little bit, do you guys still remember these two characteristics? What they are? Yeah. Okay, Leonard, would you like to explain a little bit? Okay, yeah, that's fine. This is a little bit of a mean question. Yeah, I don't really expect you guys to know that. Okay, no, it's probably fine. You know, it's there's there. You know, it's always good to share your ideas and the knowledge. There's no wrong answers in this case. Okay. Um. Yeah. So the two characteristics are first of all they are owned by the firm, by the company, and also they are in the form they are ready to sell to customers, right? In this chapter, in chapter 6, we are dealing with another type of company, right? It's manufacturing company. And with manufacturing company, there are three types of inventory: raw materials, work in progress, and finished good in inventory. Of course, there's the fourth type, but we'll get into it a little bit. So raw materials are quite intuitive, right? They're basically goods that will be used in production but have not yet been placed into production. Then you have work in progress, which are the portion of manufactured inventory that has been placed into production but has not yet been completed. Okay, and then finished good inventory are, well, as the name suggests, are basically manufactured items that are ready to be sold. There's the fourth one, which is quite I suppose, unique one. It's called just-in-time inventory. Okay, so basically, it's when companies produce or purchase goods only when they're needed, only when there are demand for it and orders for it. Okay, some of the examples of such kind of inventory are, say, fast food chain, for example. You have McDonald's and Burger King's, right? They already have the ingredients for making their menu, but unless you really order them, they won't make it. Okay, and you can also think of maybe some of the top notch, the most expensive luxury car brands. They don't really make their cars and have them sit in inventory. They only make them when you have a rich billionaire or something ordering them. So those are some of the examples. Also, you can also find it in supermarkets. For example, Lidl, they also don't have an inventory, so which is rare. Most supermarket chains actually do have a pretty sizable inventory. Yeah, so actually, I have a quick follow-up question about this concept. Why do you guys think this is the case? Why do you guys think we have companies that want to keep no inventory at all or keep a very low inventory? Again, there's no wrong answers here. Okay, I like to really encourage you guys to share your ideas. Exactly. Where people saying cost money, to pay less for storage, less inventory cost. Yeah, perfect. That's actually the answer I was looking for mainly, because of the expenses, right? That's great. Yeah, we'll get back to this concept a little bit later. But thank you for everyone's answers. Let's go to the second topic, which is determining the inventory quantities. And also, if you guys have any questions, let me know. Okay, if you think I'm talking too fast, or if you like me to repeat certain concepts, go back to certain slides, let me know. So we know that firms need to determine inventory quantities at the end of the accounting period, right? So there are two main systems that we're dealing with within the context of this textbook, right, that we're using. So the first one is perpetual inventory system, and the second one is periodic. With perpetual inventory system, it's more used by, say, bigger businesses and corporations, because it's going continuously and it's quite expensive to operate. Their main objectives of using them, the reasons, is first of all to check the accuracy of their inventory records, of course, and then the second one is to determine the amount of inventory lost due to the wasted raw materials or shoplifting or employee theft. You can also, one example that just came to mind is, for example, me sometimes going to Jumbo and trying to purchase a pastry, and sometimes I drop them in the ground by accident. They don't really ask you to compensate for that, but that will be marked off as a wasted material for example, big supermarkets. Second type of system that we use is periodic inventory system, and this is what we will be mainly focusing on during this chapter. Basically, the reasons are to take a physical inventory of goods on hand and to determine the cost of goods sold for that period. This is more commonly used by smaller businesses, and also they are taken more occasionally from time to time. So that's more economical, right? I hope that's clear. But no matter which system that you're using, there are always two steps that you need to take into account, right? So first of all, we need to take a physical inventory of goods on hand. That's quite obvious. And secondly, we need to determine the ownership of goods, right? On that topic, let's jump to third topic, which is, determine the ownership of goods. So one of the major obstacles for firms is that, oh yeah, can you just go back to my slide? Yeah, sure. If you are taking notes and stuff, don't worry about it, because we will also send the slides after this course, so it's fine. Yeah, no worries. No, well, you'll get the slides. Okay, great. So yeah, let's talk about determining the ownership of goods. One of the major obstacles for firms is that sometimes at the end of the accounting period, they have goods in transit, right? So that means they are basically on a form of transportation, boats, truck, whatever, right? You can have your goods stuck in the Red Sea on a shipping crate or something. So there are two ways of determining this. Actually, three ways, but let's go through the first two. The first of all, we have free on board shipping point. What it means is basically the seller passes the ownership already to the buyer the moment they hand it to a public carrier corporation, which you can think of it as a third-party delivery service, FedEx, for example. And so in that case, buyer pays for the transportation cost, the freight cost. In the book, we mainly deal with transactions between companies, but in real life, you can also think of examples of, say, e-commerce. I'm sure we've all purchased goods from, say, Amazon or AliExpress or some other, websites. And sometimes, if you need international shipping, then you have to pay for the transportation fee, right? So that kind of counts as FOB shipping points as well. And now we have FOB destination, which is basically kind of the opposite, right? So the ownership of the goods is given to the buyer the moment that the public carrier corporation gives it to the buyer, right? So what it means is that the seller pays for the cost. The seller, basically, as you can see in the graph, hands it to the delivery service, and then the delivery service gives to the buyer, and that's the moment the ownership is passed to the buyer. Okay. Hope that's clear. The last one we have is actually consigned goods. This is again a quite rare occasion, quite rare, but it does happen in real life. So For example, you might have a used car or second-hand item, vehicle, whatever it is. You could basically hand it to the second-hand dealership, and they will charge commission if they are able to sell it, but they don't own it, right? Because they don't want to carry the risk of not being able to sell a second-hand stuff, because well, we already kind of know that it's kind of uncertain with second-hand stuff. It's difficult to sell it, so there's a quite high risk. That's why they want you to keep the ownership, right? So this does happen with antiques as well, with boats, with of course second car dealership. So yeah, this is a rare example of it, but consigned goods. Okay, hope that's clear. If so, let's go to, I suppose, to say the most important topic of this chapter. And I think it's what most people struggle with. So that is the inventory methods and their financial effects, right? So although we've already shown an example of just-in-time inventory, but most companies don't really sell all of their inventory, right? They always keep some of the inventory at the end of the accounting period, and it's considered unsold goods or unsold inventory. So when we use, say, like as you can see here, when we have unsold inventory, they are considered an asset. Okay, inventory is asset, and then it's shown on the balance sheet. You guys, you'll remember about balance sheet. It basically contains total assets, total equity, total liability. All right, and the part of the inventory that we sold, that we managed to sell during this accounting period, is going to be recorded as revenue, but at the same time as expense on the income statement, right? You guys still remember our old friend from like chapter 4, which is accurate accounting. There's this principle called expense recognition principle, and that's the reason why we have to record both expense in the form of cost of goods sold and revenue. Okay, so the principle says that if we have revenue, we should also recognize it at the same time that expense occurs. And just last thing to define, which is total inventory. Total inventory is quite obvious, right? Opening inventory plus the purchased inventory during the accounting period. I mean, that's the total inventory. And I hope, well, I suppose it's a little bit difficult to maybe understand without a real example, but that's what I'm going to show next. So don't worry. Yeah, let's actually demonstrate a little bit the effect of it. Okay. So the premise is that we purchased 100 t-shirts at 30 pounds per t-shirt per unit, and that will give us an inventory of 3,000 pounds, right? And later on January 28th, we sell 2 t-shirts at 50 each on account. So that means we have an account receivable. That means that the buyer didn't pay it right away, right? So the buyer decided to maybe delay the payments to the next accounting period. We record it as an asset, right? If you guys actually here, I want to really again like stress the importance of this formula. I'm sure you guys already seen it before. It is a accounting equation, and with the debit and credit stuff, it's quite a little bit tricky to memorize, but this is going to be very important in the exam, and I would really encourage you guys to memorize this by heart. One of the I have a question here. Let me go back to one slide back. Yes. Oh, not what I wanted to do. Yeah. Do you have any questions? Would you like me to repeat certain parts or just take notes? Okay. Sure. Yeah. Okay. Perfect. Yeah. Again, I'd really like one method that I use to memorize this is called dealer. Not sure if you guys have heard of it already, but if not, dealer basically you can think of it this way: for DEA from the dealer, the first part of it, the first 3 alphabets stands for dividends, expense, and assets. right? If you look at the graph, assets, when you increase, you debit, right? When you decrease it, you credit it. And this works the same way for expenses and dividends. So DEA. And the second part, LER, stand for liabilities, equity, but in this case, we're talking about share capital and revenue, right? So LER, they work the opposite way. When you debit them, you decrease them, and when you credit them, you increase them, right? There's also share capital. There's also retained earning. You can also consider that as part of R, because revenue and retained earning, they will also work the same way. I hope that's a good way of that can help you to memorize it. Now that we have kind of refreshed your memory on the accounting equations, we can talk about the effects of these two actions, let's just say, on the journal entry. So DA is a normal debit. Yeah, I suppose. Yeah, that's if that's the way to call it. I'm not. Yeah, normal debit accounts. You could. Yeah. Essentially, that is what it is. It's just a trick to memorize things, right? Explain the table with the formula, please. Yes. I will. Would you like me to explain the equation or just the account the journal entry? Because I will be explaining the journal entry right now. Retained earnings is actually equity after you already. So return earnings is what basically you did after deducting expenses and dividends. It's what the owners of the company, right, are left with. It is part of the. It's kind of different from share capital. They're different things, right? You could say that it's revenue, right, that's left over. Yeah. Um, I just to clarify, I think it would be better if I can explain the. Okay. Somebody is asking if I can explain the debit and credit effects. I think it will be much clearer after I explain the journal entry with this equation. Okay, they'll be more effective. So first of all, let's look at inventory. Right, inventory is considered an asset. Since we've already talked about purchasing 100 t-shirt at 30 each, that would give us a debit of 3,000 because we increase them, we add them, and at the same time, let's assume that we bought it with cash. It's not really mentioned, but let's assume that's what it did. We bought it with cash. Cash is also an asset, right? So we deduct it by crediting this asset. And on January 28th, this is when we made this sale, we have accounts receivable, which is also an asset. It's the same as cash, but it's not really the same, as you probably already know from chapter 8. But let's just say it's also an asset. And of course, we debit it when we increase it. At the same time, we record the sales revenue, right? Revenue is a bit different, right? We credit it when we increase it. So we have an increase in asset and increase and the same increase in equity in this part, right? And lastly, due to the accrual accounting, the principle, we have to record the expense, right? At the same time, the expense is cost of goods sold, and expense is recorded when we increase it, we debit it. So we debit 60 here. And lastly, since we've debited this, we've have recorded our expense, we also have to credit the inventory, the asset, because the inventory is now lacking 60, right? We have less now due to the selling of these two t-shirts. So I hope this explanation clarifies it a little bit more. If not, let me know. Yes, COGS, cost of goods sold, is an expense. Yeah. Okay. I think there's all answers. Questions have been answered so far. Oh, another one. You guys. Yeah, no, the cost of goods sold is basically the price that you purchased t-shirt from, right? So 30 times 2. Yeah. Yeah. That's great. Okay. Now let's go to, oh yeah, I forgot. Actually, we also want to talk a little bit about, previously I said about, their effect on balance sheet and income statement, right? So let's talk about it a little bit as well on with the actual graph. So on balance sheet, we can ignore the cash and accounts receivable here because they are made up numbers. The main thing here is the inventory, right? Inventory is now 98 t-shirts with a cost of 30. So as I mentioned, we deducted this 60 from it, right? And then the effect on the income statements, of course, this is very much a simplified version of it. In the real income statements, you would be seeing not just sales revenues, but you also have all sorts of other expenses, such as I don't know, depreciation, which you guys will be learning later on probably. You have If you have debt, you have to pay interest expense. If you have you definitely have tax, so you have to pay taxes as well. So all of those would be other expenses. But in this case, in this chapter, we just talk about sales, and we just talk about revenue minus expense, which is cost of goods sold, and then that's when we find the gross profit. So here we can see we have to basically deduct revenue by the expense. It's 40. Okay, hope that's clear as well. If so, let's get to the specific inventory methods that we use, right, to determine the inventory. The first one is a little bit unique, also uncommon. Specific identification method is the name. Basically, what it is some firms, some industries, it's really hard to use for them to count their inventory in any other ways than this. Some of the examples would be, say, the sport car, industry, like the top notch, the most expensive brands of sport cars that you can think of. I'm not sure how many of you guys are interested in cars, but I'm a little bit of a car guy. So here are some examples I came up with: Bugatti Chiron on the left, and the other one is Koenigsegg. I think Jesko. These cars are very expensive, right? Of course, they all average at, I don't know, 3 million to 350, 3.5 million in price. And the main thing about them is that they are pretty much handmade, right? And highly customized and highly personalized. And they don't make them a lot either. Like Bugatti, they make 50 cars a year probably. For Koenigsegg, they make even less, probably 17 or something. So each of them, they come with their own price tag already. There's no mass production with this. Okay, they have very specific characteristics that require this method. Another example you can think of is real estate, right? There are no two houses, two apartment buildings are exactly the same. You have different characteristics like patios, the size of it, the how many bedrooms it has. All of that make them unique, and then make them only applicable to this method. Okay, but this question is I got a little bit sidetracked, but this question is not very uh, you know this method will only you might be asked in the exam to define them, but you don't need any calculations or anything. So it's not the most important one, to be honest. Let's get to the more important ones now. Of course, the first one is the average cost method. I think it's also one of the most straightforward ones. So what it does is that companies basically calculate the average cost of inventory over a specific period and use this value to calculate their assets, the remaining asset, and also the cost of goods sold. By that, I mean just finding an average cost per unit, right? So this formula is going to be very, very important. So I highly encourage you guys to memorize it. Cost of goods available for sale divided by total units available for sale. That's when you get the weighted average unit cost. And then you can apply it to assets and cost of goods sold. There's another formula that I'd like to stress a little bit. So this is the other way of, I'll be showing you one way of finding the cost of goods sold, but there's another way of finding it, which is using this formula, okay? Beginning inventory plus purchase inventory during the accounting period minus the ending inventory. I know these are concepts that can be kind of difficult to understand with just pure words, but don't worry, we will be showing you some actual numeric examples just in the next few slides. So I'm just going to go through. Oh, this is also another one, right? Cost of goods sold, but this is not very important formula, so don't worry about that. So I'll be going through them with actual examples. You don't have to worry. Let me just get through the definitions real quick. The next two methods are, first of all, first in, first out, FIFO. What it is that company basically assumes that the oldest item that they purchase will be sold first. And that means that the price of the oldest item will determine the cost of goods sold. And the inventory that's remaining at the end of the accounting period will be consisting of the most recent purchases. Right? Last in and first out, LIFO is a little bit the opposite of it. And I also need to stress that this is not accepted by the IFRS standard, which is what this book is based on. It is only a principle that US GAAP uses, but we'll be still talking about it because it's going to be in the exam, right? So what it is company assumes that most recent items to be sold will be sold first. Okay, and this means that the price of the most recent items will determine the cost of goods sold, and then the remaining inventory will consist of the oldest purchase prices. Yeah, so with the definition out of the way, let's actually see how they work in examples. Before we do that, hope everything's clear, and if you have questions, please ask away. But yeah, I don't see any questions. That's good. Oh, sorry. A little bit of, okay. Now, let's talk a little bit about the premise. So first, we have a beginning balance inventory of 100 euro. So we know that's 10 units. This is already told you. So we know there's 10 units at 10 euro each. Okay, this is what we purchased from the previous accounting period that we left over to this accounting period. Okay, and in this accounting period, we first purchased a batch of 25 units at 14 euro each. So that would give us 350. And the second batch, the most recent one that we purchased, is 25 units at 18 euro each. So that's 450, right? And then we know that we've sold 40 units in this accounting period. So how do we measure them using different methods? Let's first look at FIFO, right? So the information that we've already stated is going to be on the left side of this, let's say, journal, or I guess a T accounts. Anyways, it's just a graphic representation. What we're interested in knowing is, of course, cost of goods sold and the ending balance, right? The ending inventory. With FIFO, if you remember from the definition, we assume that the oldest purchases, the oldest goods that were purchased are going to be sold first, right? So we look from top to bottom. What makes up of these 40 units, right? First of all, the beginning balance of 10 units at 10, so 100 here, right? And then we have 30 units left, right? So the next batch, which is the next latest, the next earliest, batch that we purchased, which is the first batch from this accounting period, 25 units at 14 euro, is going in here as well. It's going to be sold. So now we have 35 units, right? The last 5 units that was sold is going to be from the most recent purchase we made. Okay, so this is the 25 units. Well, it's not really 25, it's the 5 out of the 25 times 18, so that's 90. And we will end up with a cost of goods sold of 540, right? The ending balance, now that we know we have purchased in total 60 units, including the beginning balance, minus 40 units that we sold is 20 units. And those 20 units are the ones that were unsold, right? Why 5 units? Yeah. So remember, we sold 40 units, right? 40 units, and we've already had 10 units from the beginning balance that we know we sold, and then the other 25 units from the number one purchase that we sold. So we have 35 units that were sold, right? And then the other 5 units, all of this 40 units that we sold in total, is going to come from the number 2 batch of items, goods that we purchased, right? So the 5 out of the 25. That's why we have 5 units. And the rest 20 units inventory from the second purchase is going to be the end balance, because that's 20 units that we didn't manage to sell. I hope that's clear. Right, the 20 units that we are that's remaining, that's left out of the 40 units that we sold. And I think it would be easier to understand if I show you another method. All right, so we have the second method, which is LIFO. On the LIFO, we know that we have to consider the earliest units purchased to be sold first as well. So we look from the bottom to top. So first of all, we have 25 units from the second batch times 18, or 450, right? So now we have 15 units left. That 15 units is going to be coming from the second most recent, the second latest purchase that we made. That's the first number one batch we purchased in this accounting period, right? 15 times 14, we end up with 660. Okay, and then the end balance, again, we need to account for the 20 units, right? So we know that for number one purchase, we've already sold 15 out of that 25, so we have 10 left unsold. That 10 times 14 is going in, right? 140. And then also we have to remember that the beginning balance is also unsold. So that's 10 units there. 10 times 10, 100. And adding them up, we have 240. Okay, I hope that's clear. I don't see any questions. That's clear. Let's go to the last method, which is average cost. And this is the most straightforward one, in my opinion. The only thing that we really need to do here, you can see here that we have an average cost of, or average cost per unit of 15. How do we find it? Well, if you guys still remember, we have this formula, right? Cost of goods available divided by number of units available. Basically, what we do is we have to first find, we basically add all of the total value of purchase, the cost of purchase together, right? So 100, 350, and 450, and also divide by the sum of their respective units. So we purchased 10 units in the beginning balance. We purchased 25 units in number one purchase, and purchased 25 other units in the number two batch. And that would give us 15 euro per unit. Okay. And now it gets easier, right? You just apply this 15 euro per unit to everything. So we can apply the basically 40 times 15, that's 600. And then the leftover 20 units is going to be 20 times 15, 300. Right? So this is quite easy, right? I hope that's clear. One thing that I to bring to your guys' attention is actually the prices. Okay, you can see that price per unit of each purchase, every purchase, goes up as time progresses. Okay, so let's say in the previous accounting period, we bought this item for 10 euro, but later on it's 14, right? At the first batch. And then in the second batch, which is in a later date than the first batch, we have 18 euro. So why do you guys think this happens? I don't understand the last ending balance. Okay, so the ending balance, we can think of it this way. Okay, the ending balance is basically what you have here, right? We have the total balance is 60 because we have 10 units plus 25 plus 25, right? And then total balance minus the cost of goods sold, which the example already says 40 units. So that's 20 units, okay? We know that we have a 20 units of ending balance already. What we don't know is what these 20 units consist of. That's why we have different results from different methods, right? Because from FIFO, this 20 units comes from the latest purchase, right? From LIFO, okay, yeah, great, that you answered it. Okay, hope that's all the questions answered. Again, I have this little question about why the prices are rising, but I suppose, yeah, inflation, exactly. That's quite intuitive, right? We always assume there's an inflation going on even without times of crisis or any incidents. We still have some countries have 2% of inflation expectation. So that's why the most common scenario that you will face in exam is that they would say there's a time of rising prices, right? Of course, there will be cases of declining prices, but it's rare. But we'll also talk about it in a bit. I'd just like to show you guys real quick the comparison between these three methods. Okay, with FIFO, we have well, the lowest cost of goods sold, right? And the ending inventory is the highest in this case, as you can see here. And the reason for it is because, well, we are recording the oldest items sold first. And the oldest items, because of the inflation, tend to be the cheapest when we purchase them. Right? That makes intuitive sense, right? And then that would make the ending inventory consisting of the most expensive items. So that also explains why the ending inventory is the highest. Okay, with LIFO under inflation, it's a different story. It's opposite story actually. The cost of goods sold is the highest, and then the inventory would be the lowest. Now, I think the main takeaway that I really would like you guys to remember is when we look at cost of goods sold, okay, we need to be actively thinking about expenses, and by extension, we need to be thinking about income statement, right? So when we have the lowest cost of goods sold, that would mean we have the highest net income, right? Although revenue is not talked about in this case, we just assume that there is certain revenue, right? And then if we have a bigger cost of goods sold, then of course the net revenue is going to be smaller, right? The net income is going to be smaller, and we have a small expense, right? We have a bigger income. So in FIFO, we always have a highest net income among all three methods. And with ending inventory, I want you guys to think about balance sheet, okay? Because ending inventory is going to be recorded as asset. So highest asset, well, basically highest inventory means highest asset, right? That's a very direct relationship. And so with FIFO, you have the highest net income and highest assets. With LIFO, you have the lowest net income and the lowest asset, right? With average cost, it's always in between because, well, it's average. And you can see that in also the prices, right? The cost of, average cost of per unit is 15, which is between the lowest, 10, and the highest 18. So it makes sense that the average cost is in between. I hope that explanation makes sense to you guys. If not, I can also explain again. Let me know. Okay, I think that's clear. Oh, one. The cost of goods sold always lower in FIFO. So here, yeah, the cost of goods sold is always lower in FIFO only when there's when we are talking about period of inflation? Okay, that's a very good question, actually, Anna. I will get to the other scenario, which is when there's a deflation, when the prices are going down, in the next slide. Okay, so let's go to the next slide. As I already mentioned a little bit from before, the income statement effect, right? So during the inflation, during rising prices, FIFO has the higher net income and higher assets than average cost and LIFO. I didn't really mention it here, but remember, LIFO also. But if the prices are falling, then the FIFO has a reversed effect than average cost and LIFO. So FIFO, if during falling prices, would have the lowest net income and lowest assets, and LIFO would have the highest net income and highest assets. Okay, but average cost is still in between of them. It's just LIFO and FIFO. The order of which one has the highest changed. Okay, so we need to keep that in mind in the times of deflation, because if you think about it, right, with times of deflation, then the cheapest item that were purchased, the oldest items that were purchased would be the most expensive ones, and then FIFO records the most expensive one in this case, right? And then they would end up with a any inventory of the cheapest ones left. And with LIFO, it would be the highest net income and highest assets if the prices are falling. If the price is falling, okay. I hope that makes some sense as well. All right. So with all that said, we still have to answer this question, right? Some firms still use the average cost and LIFO, despite recording with FIFO always gives the highest net income and highest asset value. And there's basically one main reason, and it's tax. Okay, if you look at income statements, before paying tax, you have what's called a earnings before tax, basically, EBIT. And usually firms don't like tax expense because it's considered a loss. So they want to report as low income earning before tax as possible. And if you can also demonstrate with like just a numerical example, right? So let's say we have a company that has 600, right? 600 earning before tax, and the tax rate currently is probably 0.21%. You will end up with a tax expense of 126. But if you report 500 earning, then you have the tax of 105. So firms sometimes they prefer to report the income to be lower so that they can save on paying taxes, basically. Yeah. That's just pretty fun fact, I think. Of course, with LIFO, I've already talked about them before. So for the disadvantages would be that during normal times, which is times of rising prices, we have significantly understated ending inventory, because so just to clarify, understatement in this case just means that it's lower than what it actually is, right? Lower than what it actually is. Because the ending inventory will be consisting of the oldest goods, right? Because we assume with LIFO we sell the most recent ones that we purchase, and the oldest prices are usually the cheapest, right? The lowest. So that's why it's an understatement. It doesn't reflect the inflationary situation that we're currently in, let's just say. And the advantage is the same as average cost. Okay, they record a lot lower net income, as I already mentioned before. So there's a tax benefit, and it's more significant tax benefit than average cost even. Hope that's clear as well. Yeah, I'm not seeing any questions, so that's perfect. Good. If so, let's go to the next topic, and that is the effects of inventory errors. previously I already talked a little bit about understatement and overstatement. Okay, just to clarify, understatement, as I've said, lower than what it actually is, and overstatement is higher than it actually is, right? For understanding the effects of, errors with reporting, we really need to look at this formula. We need to get back to this formula for cost of goods sold. And this is also the second way you can calculate cost of goods sold in the exam. Okay. So first of all, we basically have beginning inventory plus cost of goods purchased in this period, and then we deduct it by the ending inventory, right? This is something that's very important to memorize. And we can use it to really see the errors, right? So, for example, when we understate the beginning inventory, what happens is the beginning inventory in this equation becomes smaller, right? And when we have a smaller, this number is, let's just say all of these are numerical numbers, right? Numeric examples like numbers. And this number is smaller, then this whole thing becomes smaller, right? The cost of goods sold becomes smaller. That is why it's called understated. And if you have an understated expense, what happens to net income? It's bigger, right? That makes sense? No, no. I'll explain to you again. So if we look at the equation here, right? The beginning inventory is smaller. And to understand, I just explain again. So the beginning inventory is smaller than it actually is. That makes this entire equation on the left smaller, right? And that is why cost of goods sold is smaller as well. And on the income statement, we look at revenue minus expense, right? And if we have a small expense, then that would mean that we have a big net income. So that's why it's overstated. I hope that's better now. All right. So if we look at the opposite situation where the beginning inventory is overstated, okay, so that means it's bigger than it actually is. So when we have a bigger beginning inventory, this equation, the cost of goods sold would become bigger as well, overstated. So we have a bigger expense, a larger expense, and that would make the net income smaller. Okay. Hope this is also clear. And let's look at what happens to ending inventory. So with ending inventory, because we're deducting it, right? In this case, so we deduct. So if we have a smaller ending inventory, we deduct less, and this equation would therefore be smaller. Sorry, this equation would be bigger because the beginning inventory, say a number, and cost of goods sold another number. This deducting less of any inventory would make the cost of goods sold bigger than it actually is. So we have a overstated cost of goods sold. We have an overstated expense, then we have a understated net income, right? Holding the revenue constant in this case. The other way around, we have overstated ending inventory, then that would result in a understated cost of goods sold and overstated net income. Yeah, so this is like it's a little bit of a complicated relationship that we need to figure out a little bit, but I think if you can memorize this formula, it will be very useful in terms of dealing with questions like this in the exam. Yeah. And let's also look at the financial statement, the effect of what they call it, statement of financial position, but usually you can also just call it balance sheet, right? That's why I prefer it's much easier to memorize. The effect on the balance sheet. So you remember balance sheets, asset, liability, and equity. In this case, we only look at ending inventory because that's when we put them as assets in the balance sheet, right? So the two cases, overstated. If the asset is overstated, right? We remember from the equation, asset equals to liabilities plus equity. In this case, liabilities doesn't have anything to do with inventory and stuff. So to make the equation equal, right? When we have a bigger asset, we have also a bigger equity accordingly. So equity overstated. On the other hand, if we have a understated assets, we also have an understated equity. I think this is a little bit more like intuitive and more clear. I hope you guys are following. Yeah, I don't see any questions, so that's good. That's a good sign. Okay, so let's go to the last two topics. Actually, let's talk about the presentation. This is now very important for the exam. So what we need to do for the presentation of the inventory statement is we need to keep in mind we have three things to disclosure. The first one is the classification of the inventory, how you classify them. Of course, we talked about it before. Secondly, we need to talk about the type of cost we use, which is going to be the next topic. But let's just keep in mind we have either cost or lower of cost or net relative value. It's very mouthy. The third one is of course, the method that we used to record it, right? It could be FIFO or average cost. LIFO is not here because, of course, it's not accepted by the IFRS, right? So let's go to the LCNRV, which is the lower of cost or net relative value. It's kind of like the name is very annoying, but what it is, right? Essentially, it could be better explained with an example. Okay, for example, companies like Apple, they release products like iPhone every 2 years or so. I don't even know the latest model. They have so many iPhones coming out. So let's say we have a iPhone 15 or 16 coming out today. Then that would make the previous iteration, the 14, iPhone 14, irrelevant, right? So people would be immediately going to buy the newest model, and then nobody's really going to buy the older model, right? And then that would mean that the price of iPhone 14 is going to drop significantly. So what happens there is that we have a cost that is higher than the selling price. Okay. So accounting principle usually requires that the inventory to be valued at a lesser amount of its laydown cost, and at the amount that it's likely to be sold. So what this net relative values role here is we compare it with the actual total cost that you have, right? As you can see this formula, right? We use the estimating selling price to like expecting the expected selling price if the shock of releasing the new phone didn't happen, right? Minus the estimated cost. So this is a kind of an estimation of the cost of the kind of shock between this release and the normal cost of business. What we basically need to remember is that if NRV is higher than the total cost, the actual total cost, you use the actual total cost, the normal cost, right? And then if the NRV is lower than the actual total cost, you use the NRV to value the inventory. This is basically the kind of the protocol that you use to determine which value to use. Okay, which is why it's also called lower of cost, right? And because NRV is lower than the actual cost, we need to adjust it in a journal entry by adding this additional expense of cost of goods sold called inventory write down. And basically what you do is credit the amount that's NRV minus credits NRV minus normal cost of goods sold. You deduct it to kind of compensate for this unexpected event that happened. Okay. So next, let's also go to the two new ratios that we learned from this chapter. This is mainly used for analysis by the investors. The first one is inventory turnover, which measures the basically the liquidity, right? The time it takes for a firm to sell their inventory, and we calculate it based on cost of goods sold divided by the average value of inventory. And if you guys are curious, average value of inventory just equals to beginning plus ending inventory divided by 2. Okay. The second ratio that we can use is actually based on the first one, right? So days in inventory is a variant of it. Basically, it calculates it tells you the amount of days that a firm can sell their inventory. So days in inventory equals to 365 divided by the inventory turnover. We've already mentioned previously that some firms, actually most firms, prefer to keep their inventory level low, right? So to reduce costs. So what we can use to assess if a firm is successful or profitable is by looking at whether they have both low level of inventory and high level of turnover. Okay, so that they can still satisfy the customers, but also minimizing the costs of keeping items in the inventory. Hope that's clear as well. Okay, I'm not seeing any questions, so that's great. And lastly, you have this Appendix 6D content. It's going to be relevant for the exam as well, but really, I think the most important part is just to memorize the formulas here. So basically, why do we need to estimate inventories? Well, sometimes we have, for example, accidents or disasters that could basically render all this inventory loss. That's where we need to estimate them. There are two methods of doing that. In essence, gross profit method, you just need to memorize these 2 steps. Okay, so in the exam, you will be given the numbers for net sales as well as the gross profit rate, which is going to be a percentage. So what you need to calculate in this case is the estimated gross profit, which equals to net sales times the gross profit rate, right? And then net sales minus that estimated gross profit will give you the estimated cost of goods sold, right? And then that's the second step. We use the cost of goods available for sale, which is also going to be given to you in the exam, minus what we found previously, the estimated cost of goods sold. Then that's how we find the estimated cost of the ending inventory, right? The second method is a little bit more complicated, actually, but they also might be asking you in the exam. So the first step, again, a lot of information is going to be given, right? So goods available for sale at retail is going to be given, minus net sales also given. That's when you find any inventory at retail. And the second step, we have to find the goods available for sale at cost. This is also given, divided by the goods available for sale at retail to find the ratio, right? A good way to memorize this is, ratio is usually the numerator divided by denominator, right? It's always the case. So in this, the name is basically suggesting the cost divided by retail, right? So when you see them in the exam, you just remember this is the way you calculate ratio, and it's quite simple. The last step is basically the ending inventory at retail. You want to basically multiply the answer for your first step to the answer of your second step, and that's how you find the estimated cost of any inventory. Okay. Really, the best advice I can give you guys to memorize this. Yeah. Any questions? If not, let's go to the exercises. All right, the past exam exercise. This first one is going to be about FIFO, and I suppose I'll give you guys maybe 2 minutes. And if you are down, please let me know in the chat. Getting some answers. Pretty cool. let's give a little bit more time for other people to answer. Okay. C. Somebody says C. Okay. Interesting. Okay. Nice. Nice. All right. Leonard, you can actually do both, right? If you also if you guys want to private message me, you can, but you can also just send it in the group chat. Okay. I suppose I've seen a lot of people answering C, right? And that is correct. So I'm really happy that all of you guys are master of this content, right? This concept of FIFO. So here's a little bit of explanation, but you guys already did them correctly. So of course we have 45 units that were sold, and that would mean that using FIFO we look from top to bottom, right? We have the 20 units from the beginning inventory plus the 25 from the first purchase that we made. That would make up the 45 units, and then simple math, we get 250. Right? Great to see all of everyone getting the correct answer. Let's go to the next two little exercises. These are more conceptual. If you guys like, you can also answer both of them. Maybe I'll give you guys 2 minutes each. Let's see how fast you guys can do it. I'm seeing a lot of these. That's very good. Um, Maybe let's just first solve the first question. Okay. So I see most of you guys have answered B. Would someone like to maybe explain a little bit? Would someone like to volunteer? Just explain. You can unmute yourself, or you can type in the chat to share how your like your rationale behind this answer is. I guess actually I guess I'll just reveal the answer then. It's actually B. Yeah, you guys did them correctly. And oh yeah, okay. Sorry, Leonard. I went a little bit too. Yeah, Leonard said the price is right, then the first goods were the cheapest, so your cost of goods sold are lowest. Exactly, right? Exactly. It's a perfect answer. That's exactly what I was looking for, right? For FIFO, remember, we yeah, as Leonard said, in a period of inflation, we always sell the oldest item, right? They were the cheapest, the cost of goods sold lowest, and then the balance would be the most expensive items. So that would make the asset valuation the highest, right? Let's also do the second one then. Okay, this is a little bit tricky, right? With NRV. Okay, C or D, C. Interesting. Right, I'm seeing a lot of people answering C. That's great. And later changed to C. Yeah, it's great that you guys all did the correct answer. That's really perfect. Um, yeah, that is actually the correct answer. And the reason for that is, we just need to keep in mind of the formula of net realizable value, right? So it's estimated selling price in the normal course of action without, any shocks or any unexpected change that would make the price lower than the cost, minus the estimated cost to complete and sell. Okay. And the reason D is incorrect is because they're talking about original cost, right? The original cost is actually what we're trying to use with the reason for NRV is an alternative to the original cost, right? So that's why we don't use it. So hope that's clear, right? And we're answering correctly, so that's really glad. Okay, just quickly before we're getting to the next few questions, I'd like to uh, ask you guys to do me a favor. So, and scan this QR code real quick. So this will lead you to a short evaluation form for me and this course. So in Athena, we take this feedback really seriously, and I'd be really grateful if you can fill it in. It will take maximum like 1 minute. And since there are only 5 questions, I'm sure you guys can finish it really quickly. So and also please let me know what I can do in the future to improve and be better in my trainings. If I don't read anything at the end, I would just assume that I hope that I'm a 10 out of 10 tutor for you guys today. And yeah, I'll give you guys some time to answer it, and then we can continue with the practice questions once you're done. Okay, let me know when you're done in the chat. Thank you, Irene. Thank you. Thank you everyone for already submitting the evaluation form. I will just wait for a little bit longer for others to fill them in. Okay, then we can continue. Thank you. so much. All right. Great. Let's go ahead to the last few questions of the day. Okay. So let's begin with the first one. Again, I'll give you guys maybe 2 minutes. Just a little bit of hint. Um, as you can see, we're asked for cost of goods sold, but you know, in this case, we have to use another alternative way of finding it, as opposed of the first question that we did. Seeing a lot of these. All right, I think time that we reveal the answer. That should be. You guys are all correct. That is wonderful. So exactly as you guys have calculated, right? We use this formula. We just need to memorize this formula of cost of goods sold of beginning inventory plus purchase minus any inventory, right? So if you can remember this one during the exam, and they always have all the information just given to you. So that would be I would say a 3 points, right? It's perfect that you guys have already able to recall this formula. That's great. Okay, let's jump to the next one then. This is a little bit tricky with the ratios. Um, yeah, hope you guys remembered it. If not, let me know. Okay, maybe let's first tell them. Pretty fast. Saying that maybe people are struggling a little bit with the formulas. I'll give a little bit of tip. Okay, these are the definitions. These are the formulas that you need to know. Right. With the formulas for accounting, I unfortunately think that you guys won't have a formula. I think from last year, from my experience, because I did accounting last year as well, I didn't really have a formula. So a lot of the things I think you need to rely on your memory in the exam. But you can always ask your coordinator, right? Send them an email and just to ask them to clarify if there's going to be a formula. If there is going to be a formula, then it's going to be great, right? You don't have to do all this tedious memorization. So okay, I'm seeing people answering A, right? That is great. That is the correct answer. Right? It can be a little bit tricky, right, with these ratios. But essentially, what you do is we first need to find the average value of inventory, and that is the beginning plus the end. So 70 plus 90 divided by 2. That's the average, right? And then for the inventory turnover, we have the COGS, the cost of goods sold, that is already stated, which is 360 divided by the average inventory, so 80. That's 4.5. And then lastly, to find days, we need 365 divided by 4.5. Okay, that's how we find it. Oh, we're running out of time a little bit. Um, I don't want to waste your guys' precious time. So for the last one, um, I'm not sure if you guys already can, have an answer, but uh, let me know in the chats. You guys have any? You guys have already came up with an answer. Okay, that a B? Hmm? You get it without the inventory turnover to save time by applying days inventory to average inventory divided by cost. Hmm. Yeah, I think your method also would work, right? It's kind of just like the simplified version of the formula. Yeah, I think if it gets you the same results, then it would work. Okay. Oh, I'm seeing a little bit of different answers. Sorry for going over time. Okay, that's great. That's great. Then that method would also work, right? Hey, I'm getting A's. So just and C. That's interesting. The first time we have a large variety of answers. D. Okay, D. All right. Let's reveal the answer. Okay. It is actually B. Right? The reason of it, uh, this can be a little bit tricky, right? The ending inventory in this case is understated, so it's smaller than it actually is. Okay, so the effect of it on cost of goods sold, which is an expense, is, so you can see here, when you have an understated ending inventory, that would mean that if you look at the cost of goods sold formula, right? If you recall that, what you need to deduct is a lot lower, right? And that would make the cost of goods sold overvalued in this case. And then that would make net income understated, right? I hope that clarifies it. This is something that is a bit tricky, but yeah. Once you understand the relationship between them, it's good to be able to do them quite quickly. Yeah. So I'm sorry for going over time by 2 minutes. Just one last question. After we've gone through the entire chapter, how much more confident do you feel after this class? 8. 8. Okay. 9. Nice. Nice. That's really what I like to see. It's great. That's perfect. I'm seeing increase in your confidence. It's wonderful. Okay. Great. Okay. 8. Good. Lydia, no worries. I think with theories, it's more about, yeah, unfortunately, memorization, right? With the slides, by the way, unfortunately, I'm not responsible for distributing the slides, but my manager will send you the slides afterwards. So it's going to be in your email, most likely. All right. But I'm glad, very happy to see all the improvements in the confidence. So I think, yeah, it's this is the with that we have reached the end of this course, and I thank you so much for again attending this course, spending your time here, and yeah, thank you so much, and have a nice evening. Thank you, thank you. Bye, bye, everyone.